Hello, everybody. My name's John Bainham from Retirement Income Group, and today we have Dennis Mitchell with us to answer a few questions. Dennis is currently the CEO and CIO of Starlight Capital, and he was previously the CIO of an asset management firm where he oversaw 18 billion in assets and directly managed 3 billion in real assets, I think. Dennis has won 4 Brendan Wood International Canadian Top Gun Awards and has led investment teams that have won 2 Lipper Awards for Best Equity Fund Family. So, hi, Dennis. It's great to have you with us.
Hi, John.
Appreciate
Thank
you
you for
taking
having
the
me.
time out of your day.
Nice to be here with you, Dennis, and thanks for your time.
Thank you, Evan.
Yeah. So, first of all, you're obviously an incredibly successful portfolio manager. What would you say is unique about what you do in your process?
Well, first, thank you for the intro. I like that. Um, I would say the unique thing about our process is that we're investors, and that may sound trite, but when you listen to a lot of the investment commentary that comes your way, what you'll find is that most of it is geared towards trading, right? People are setting up for this event or reacting to this event, and oftentimes when they start talking about the holdings in their portfolio, they will talk about some obscure trend or theme that they're capitalizing on. At Starlight Capital, we are first and foremost investors. So we're looking for great businesses, which means our process starts by identifying companies with strong recurring cash flows generated from a portfolio of irreplaceable assets that are capitalized with low debt and run by management teams that behave like owners and treat us like partners. When we find those businesses, then it's on us to not, and the difference comes in that we're not asking businesses to do something they've never done. We're asking businesses to continue what they've already done. And our key ability here then becomes patience, waiting for the market to forget about these wonderful businesses or undervalue all of them like they did in March of last year during the pandemic. And that's when we move in and put large amounts of capital to work. And then we let the business do the heavy lifting. We let the businesses continue to grow their free cash flows, reward us with rising distributions, and allow the businesses themselves to make us look smart, if you will. So that I think is what's unique about our process. And you'll find that we spend a lot of time talking about the companies and less time talking about ourselves. Because at the end of the day, we are allocating capital into these businesses and they do the heavy lifting.
Beautiful.
Excellent. Thank you.
Yeah. And we were chatting about this a little bit before we started recording. But I know me personally, and I know you were just mentioning some Zoom fatigue. But I get a lot of questions about, are people actually going to go back into office buildings? Is brick and mortar retail dead? What do you see as a real estate investor actually happening out in the market?
Sure, great question. So I'll take office and retail separately because they're a little different. So with office, what you'll find is that the impact from the pandemic is neutral to slightly negative. And the reason I say neutral is because there's nothing positive about the pandemic for traditional office, right? It's not as if more people were going into the office because of the pandemic. And so from that standpoint, the best case scenario is neutral. Everyone comes back. What's more likely to happen is that a good chunk, a material chunk of the population that historically went into the office to work will begin to work from home for 1 day a week, 2 days a week, or you'll have a distributed workforce where some people work from home, maybe people who aren't necessarily focused on the culture of the organization, and others will continue to come into the office. So for people out of the office, I mean, if you've got a sales force of any kind, they should be maximizing the amount of time they spend with their clients as opposed to in the office. So it may revert to a policy of those people always being out of the office as opposed to being in the office 1 day a week or 2 days a week. Now, the other thing I would point out is that, Starlight Capital, we've got, Starlight Investments, our parent company, has got over 300 employees. And when we first talked about bringing people back to the office, we had over 100 volunteers, and they disproportionately skewed younger. When we started to think about it, we realized that a lot of these people were living in 800 square foot boxes in the middle of the sky. And so absolutely they wanted to come back to the office because they wanted to see people. We talked about Zoom fatigue. These people just wanted to get out of that box and see other people. And so again, for office, it's going to depend on the company. We had a presentation last year with a very large, we're talking $1 trillion plus financial services firm, and they had been back in the office since May. And they simply paid for all of their employees to be tested every day. So you can see that it's going to be employee dependent, position dependent, company dependent, and I would argue even geographically dependent. The US's approach is going to be different from the approach in France. So I think the impact on office is neutral to negative. And at the end of the day, if you own the best quality real estate, if you own the best quality offices in desirable gateway or money center markets like Toronto, New York, Paris, London, Hong Kong, that's where you're going to have the least impact from the pandemic. Now, pivoting to retail, there was already an established trend of successful retailers adopting a hybrid model. You had seen Amazon purchase Whole Foods as their first foray into bricks and mortar retailing, and you saw Walmart purchase Jet.com to revamp and reposition their own internet offering. When you look at retail, there are two long-term drivers that have driven retail. It is the cost of their distribution model and employee headcount and cost. And so you've seen the migration of retail away from downtown locations to suburban locations and now to online. And that really reflects the declining trend in their real estate costs, right? And that's obviously accrues to their benefit. Then it becomes headcount. And so you can see you've gone away from big do everything department stores staffed with 30 people per floor to suburban locations that are bigger and coincidentally with smaller numbers of employees to now online, where a lot of it is automated or algorithm driven, and really you've just got a warehouse with people in it. So the model for retail is going to morph to a hybrid model. And the reason I say that is because you can only go so far in terms of reducing real estate costs and headcount costs. At some point, you're going to want to maximize the impact of having one-to-one face-to-face contact to provide ancillary sales. So for instance, if someone purchases something online and decides they want to return it, it's much better for the retailer if they return it in person, because that gives you a second chance at the sale, right? Why are you, we actually had a nanny looking after our children for a while, and she used to order things off of catalog. She'd order the same dress in 2 different sizes and 3 different colors and return 5 of them and keep 1. Well, if she had to go in person to return them, now there's a dialogue. Why are you returning these dresses? I kept this one in this size and this color. Well, if you like this color, I have this outfit in this color. Here are the accessories that go with it. Here are the shoes that go with it. So that's one example of why a hybrid model is going to maximize revenues for retailers while at the same time minimizing headcount and real estate costs. So for retail, I think the pandemic has just accelerated what's a long-term trend towards a hybrid model for most successful retailers.
Great answer. Thank you. I'm just going to interject with a question, if I could, more of a macro question. Just wondering if you have any concerns about the markets right now. I'm thinking things like quantitative easing, sovereign debt, interest rates, the bond market. And I know you have to be very in tune with all these different areas. People think, you're a REIT guy or an infrastructure guy, and so therefore you don't need to know this other stuff. But we know you absolutely do need to have that expertise in different areas to be able to anticipate what is going to happen as best you can. So I'm just wondering if you have any concerns around all of that macro, activity that is going on at this point.
Absolutely. And we've coined a new phrase in terms of recoveries. We've now talked about K-shaped recoveries, right?
Yes.
And so you've got the people who were doing well before the pandemic continuing to do well, and people who were doing poorly before the pandemic doing disproportionately poorly as well. That extends onto countries as well. So if you look at the impact of the pandemic, arguably the United States did not have the best response initially to the pandemic. And now they're ramping up in terms of the rate of vaccination, and the US economy is surging ahead. I would argue that they are the upper band of the K, where those countries that were doing well before the pandemic are recovering and prospering after the pandemic, as opposed to other countries that were struggling going into the pandemic. And this has just exposed structural weaknesses. So what I would say is that countries that were well positioned continue to do well. And so when you look at performance of equity markets, it should be no surprise that the S&P 500 was one of the better performing equity markets. And it shouldn't surprise people that markets that are more geared to cyclical industries did disproportionately worse. If we extend that to balance sheets, the United States, Canada, these are countries that are not going to have difficulty with their sovereign debt issuance going forward. We released a budget recently in Canada, and the deficit is going to be $100 billion. Well, the additional spending is over $100 billion, driving the deficit to over $350 billion. Canada won't have we still have a AAA credit rating, and so Canada won't have an issue, issuing that debt at low interest rates and servicing it if all goes well. There are other countries that will not be able to tap into sovereign debt to that extent. And so the impact will be felt disproportionately by their populations. And so the question then becomes, how will they be able to subsidize and fund the shortfall in economic output, the shortfall in household incomes? And what will that mean in terms of austerity? Remember that term from 2009, 10?
Yeah.
How will they deal with the resulting austerity, and what will that mean for their domestic economies? I think that bodes well for developed nations, large nations, and for your traditional industries that have been your traditional industries that have been reliant on mature economies like the United States, like Canada, like Western Europe, to be able to actually to create demand for those industries. So some cracks in the armor, if you will, and I think that means that from a geographic standpoint, you want to skew a little more defensive.
Perfect. Thank you.
Okay, perfect. And then, so next question, I mean, you touched on the United States there, and they obviously just passed a massive stimulus bill around infrastructure and the economy. How do you think that's going to impact the global economy and your investment portfolios specifically?
Yeah. So the bill that was just passed was the American Rescue Act. And so that was more focused on COVID relief and vaccine rollout and replacing household income. The more recently announced American Jobs Plan will probably be passed sometime later this summer. And that's where you've got over $1 trillion earmarked for infrastructure in particular. So what we think the impact will be from that is obviously companies that have existing infrastructure assets, companies that were positioned to supply future infrastructure assets will benefit disproportionately. Probably it's best articulated by showing you an example of a company. So there's been a lot of talk in the infrastructure spending bill that it goes beyond just traditional infrastructure. Your planes, your trains, your ports, your bridges, airports, those are all included. But now they're talking about additional emerging types of infrastructure like high-speed internet, like, it extends all the way out to childcare and everything in between. And what I would say is that a company like Crown Castle is well positioned to take advantage of that spending on new and emerging types of infrastructure. So Crown Castle is primarily known as a US-focused cell tower REIT. And so they operate a network of cell towers that service Sprint, Verizon, AT&T, and so forth. That's the bulk of their business. And the reason I single them out, as opposed to American Tower or SBAC, is because their portfolio is almost 100% in the United States. So any domestic spending will accrue disproportionately to them. The other parts of their business include a broadband internet business. So part of the bill is to extend high-speed internet access to more rural locations. And so Crown Castle will be positioned to take advantage of any spending in that area or any request for proposals in that area. And again, because their business is 100% domestic, almost 100% domestic, and they do have exposure to broadband internet, they would tend to benefit from that. And there are a number of other companies that will benefit from various aspects. Like, for instance, there's a focus on electronic vehicles, specifically charging stations and the related infrastructure. There are a number of companies that we own in our portfolios that will benefit from that type of spending. And it's not just accruing to infrastructure companies. I mentioned Crown Castle. They're actually a REIT, a real estate investment trust. So there are a number of real estate vehicles that will benefit from this infrastructure spending as well. So we see it as bullish, a very big positive, and we're looking forward to that bill passing substantially in its current form sometime later this summer.
Perfect, thanks. So interest rates have risen very quickly this year, and real estate tends to be sensitive to interest rate fluctuations. Where do you see rates going this year, and how do you think this will impact your funds?
Yeah. So to say that interest rates have gone up is an understatement. They've gone from about 1% to at a peak 1.75, which is still near historic lows, but on a percentage basis, that's a 75% increase. It's enormous, and in a very short period of time. So sectors like real estate, utilities, they tend not to perform very well when the long end of the yield curve is rising, and even less so when it's rising that much, that quickly. Now, having said that, our analysis indicates that once the rise in long bond yields is finished, then real estate and infrastructure tend to outperform for an extended period of time. And I think the reason for that is if you look through why the long end of the yield curve is usually rising, it's usually a function of inflation expectations and growth expectations increasing. And so when that is happening, people are willing to take more risk. Capital comes out of the fixed income market, it goes into more riskier assets. That usually leads to economic growth and output, and that leads to an increased demand for infrastructure and real estate. Right? I mean, if the economy is expanding and you're hiring more people, you need more office space. If you're shipping more goods, you're probably going to need more distribution space. And if people are doing better, then at the very least, they're going to rent a bigger apartment or they may transition into home ownership. So all of these things are generally bullish for real estate and infrastructure over the long term. But in the short term, as the long end of the yield curve is rising, these sectors tend to underperform. So we have taken the pullback in real estate and infrastructure as a chance to buy. And as the long end of the yield curve is paused and now come back in below 160, real estate and infrastructure have been two sectors that have, again, reclaimed market leadership.
Excellent. Good answer. Thank you very much.
Yeah, and a related question as well. You mentioned inflation. Are you worried about inflation, and do you think that's going to have a negative or positive impact on your portfolios?
Yeah, so when I first went to business school, you learned all about the evils of inflation, and everything was geared towards combating higher inflation. I think the textbooks were written by people still recovering from the early 80s. And so, of course, you begin your money management career, and what is the biggest challenge? Creating inflation. And everybody is focused on how are we going to create inflation. And we've been in a low growth environment pretty much since 2008. So, the world is kind of on its head. So it's refreshing to be asked again, finally, am I worried about positive inflation? So what I would say is that there's two types of inflation that we're on the lookout for right now. The first is widely expected, and it's because last year Q2 and Q3, we're lapping the sort of biggest shelter in place, the most draconian shutdown orders of the pandemic from last year. So we are going to see a significant uptick in inflation. And so that is largely transitory. And pretty much every major central bank in the world has pointed out that they expect inflation to pick up in Q2 and Q3, but they all think it's going to be transitory. I think so that's one piece of it. I think the second piece that's a little more nuanced, a little more complex, that has people a little more concerned is we are seeing the reopening of major economies across the world. So the United States and the UK and Germany are three examples. Japan would be a fourth. And we are also seeing significant stimulus being rolled out. So there's a lot of attention being paid to the stimulus that's being rolled out in the United States. A number of countries in the European Union are also readying additional stimulus. So the question then becomes, at a time where economies are reopening and GDP growth is about to surge and jobs are being created again, we're now going to also get another wave of stimulus money, if you will. So I think the concern there is that there'll be a second wave of inflation and that it might be more structural in nature and more persistent. So that's the inflation that people are keeping their eye on. Again, from my standpoint, one of the great things about real estate and infrastructure is that they tend to be industries with that provide an essential service in a supply-constrained manner to a big portion of the population. So, for instance, we own a company called Ferrovial. It's a Spanish company that owns the 407 toll road in Toronto. Regardless of how much money is printed or how high inflation goes, there aren't going to be 2 or 3 competing toll roads constructed. So to the extent that inflation picks up, the 407 is going to be a beneficiary with increased volume of traffic on the 407 and the ability to raise tolls at CPI plus. So again, if you're expecting inflation to pick up meaningfully and sustainably, then you want to reorient the portfolio to companies like Ferrovial that have the ability to absorb that inflation without being exposed to a rapid increase in supply of the service they provide. That's an important part important thing that we've been looking at in the portfolio for a number of months now.
Good, thank you. And we've been getting this question a lot, as I'm sure you have, from clients and others. What are your views on the Canadian housing and real estate market in the foreseeable future?
Right. So I'm of two minds, and you have to be, because anything to do with housing has a significant political bent to it. And so I'll address that angle of it first.
Mm-hmm.
So from a political standpoint, the Canadian economy has been so resilient, and part of that has been the housing market. And so as a result, our economy, I would argue, is now overly reliant on a very strong and improving housing market. And so it means that it's unlikely that the Bank of Canada is going to move prematurely or sooner to raise interest rates. And it is unlikely that the federal government will take any steps to disrupt the domestic housing market. Now, in the budget that was just passed, there was talk of putting on a 1% tax on vacant housing units. That will not deter foreign investors from continuing to buy housing stock in Canada. And that's a long tangential discussion that I'm happy to get into probably on another call. But from the political angle, it is highly unlikely that the federal government is going to take steps that would undermine the housing market. Now, from a purely economic standpoint, one of the reasons the housing market in Canada has been so resilient, and I have to remind people that in 2008, 2009, the housing market in the United States and pretty much everywhere in the rest of the world absolutely imploded, right? Home values collapsed by 40, 50%. Huge financial services companies like Lehman and Bear Stearns absolutely went bankrupt as a result of their holdings in the housing market in the United States. The Canadian housing market paused, plateaued, and then continued to march forward. And so recognizing that and recognizing that the housing market in Canada is very resilient for a number of reasons and very different from the US housing market in a number of important areas, I think one of the things that has driven it is immigration, right? And so Canada, people are surprised to understand that Canada is the fastest growing G7 nation in terms of population and has been for a number of years, and it's driven by immigration. And so the pandemic has put the brakes on immigration in Canada. We didn't hit our 2020 targets, and it doesn't look like we're going to hit our 2021 targets. Now, the federal government has now extended and increased the immigration targets for 21, 22, and 23 to make up for that. So I think the federal government sees its job in terms of housing is to preserve the existing attractiveness of the housing market, to underpin it and support it until organic immigration kicks back in and carries the market forward again. So we think that the housing market remains robust. There are certainly some, some frothiness in some areas. Everyone can point anecdotally to a story of a house that is sold for 20%, 30%, 50% over asking. So long as those properties are occupied by Canadians actually living in them, then you're probably shielded from the worst potential downside, i.e. no one's mailing in the keys and going away. In Canada, you're personally liable, for those mortgages and continue to be so. So as long as we don't see widespread job loss, then I would say the housing market is resilient, will continue to be resilient, and will continue to be underpinned by robust immigration policies as far as the eye can see.
Perfect. Thank you.
That's great. So one last question actually. So is there anything that you're concerned about in the market right now? I mean, it sounds like you're, pretty happy with what you're seeing. And, where do you see opportunities for future growth?
Yeah. So I think the one challenge that I see in the market right now is that putting aside COVID, putting aside the tremendous response in terms of stimulus and deficit spending, I think the issue that I have is that a number of, if not all companies have recovered to pre-pandemic levels and then some from a valuation standpoint. And so you're very, very exposed to earnings season right now. So companies that disappoint are not going to sell off 2 or 3%. They're going to sell off multiples of that because they will lose the robust earnings projection and they will lose the multiple that's being applied to that or robust earnings projection. So you've got significantly higher downside for disproportionately lower or less disappointment. The other thing that I would say is that things don't get much better than they are right now. I mean, even with long bond yields rising 75 basis points, you're still sub 2%. So we would expect long bond yields have a little further to run, maybe to 2.25 at the very most, but you're still at historically low rates. And so, it's hard to say that, interest rates are going to improve the outlook for multiples, for earnings, for productive growth. And the last thing I would say is that next year at this time, we'll be talking about fiscal drag, right? You've got all of this fiscal stimulus priming the pump right now. Next year at this time, we'll be talking about fiscal drag because we're not getting that stimulus spending. So all of those things are minor, I would say relatively minor negatives, but when you put them all together in the brew that we have now, where valuations are where they are, where visibility going forward is a little murky, it provides the opportunity for the market to sort of pause and check back. So it wouldn't be out of the ordinary for the market to correct 5 or 10% in a short period of time on the result of this, where we find ourselves. And again, if you've got names in the portfolio that disappoint, even for the current quarter or 2 quarters out, then you are exposed to material downside risk. So those are the things that concern me. But if you're looking long term and you boil it down to the really relevant macro things, GDP growth is recovering and is set to accelerate higher. Interest rates, even if they back up to 2.25, are still closer to historic lows than they are any type of recent high. And inflation, again, it's tame right now. What we're going to see is a transitory spike, and then the question becomes, are we going to see a more meaningful, sustainable increase in inflation? So those are kind of the points that you're looking at. But all in all, things feel good. They feel like they're getting better. And so it's just a question of avoiding the torpedoes out there. It's almost like a game of battleship, right? You want to avoid those torpedoes and not have someone sink your battleship.
Right on.
Yeah, that's perfect. So yeah, and then where do you see any opportunities for future growth? Maybe, I don't know, I know I've heard you talk in the past a little bit about multifamily housing units and things like that. So do you see, any other opportunities or?
Yeah, so we always start with the companies and find good businesses, and then we try to understand what is driving those businesses. So for instance, I'll use industrial real estate as the example. If you do any kind of screen in terms of cash flow growth, in terms of distribution growth, then companies like Prologis and Duke Realty will leap to the top of your screen. And so when you dig into what is driving those companies, you'll quickly come to the conclusion that it's e-commerce. And so then you ask yourself, okay, what is driving e-commerce? Is that sustainable? Is that a long-term trend that I can bank on? So when I look at e-commerce, I mean, Amazon is the best example of e-commerce, right? And the United States is probably the best market as an example of what can take place. So last year in the month of April, so a year ago, 40 million Americans purchased something online for the first time. And that, of course, is driven by the pandemic. People were forced to shelter in place. And so even for basic necessities like food and toothpaste and so on and so forth, they had to order it online and have it delivered. And so, of course, there's a spike in e-commerce activity. But for every $1 billion increase in consumer spending or online spending, that creates incremental demand for 1.25 million square feet of industrial real estate to support that. So just to put it in context, last year, Americans spent $861 billion online, and that was an increase of 44% year over year. E-commerce has now reached 21% penetration in the United States. The incremental demand that creates for global industrial real estate is in the hundreds of millions of square feet. And we came nowhere near adding that amount of capacity last year and will not for several years to come. So when you start looking at the fundamentals for industrial real estate, incredibly robust demand going forward, a significant lag in terms of supply response, and a fundamental outlook from a growth standpoint and a distribution standpoint that supports sort of that multi-year growth. So when we start looking at these companies, they screen well historically, and then going forward, we can see resilient demand. And so we're willing to allocate more and more capital into the industrial real estate space because we can see that huge runway. And there's very little in the way that would underpin or undercut that long-term runway of growth for these businesses. So those are some of the things that's one area. Data is another area. I built a new slide for my presentation the other day, and it features a slide that says a minute in 2020, and a social media minute in 2020, and it chronicles things like every minute of 2020. 400,000 people were hosted on Zoom calls. 147,000 videos were uploaded to Facebook. Like, it's just an insane amount of data that is created every minute of every day in the year 2020. And so the question becomes, where do you store all of that data? Well, you store it on servers located at data centers. And so you think of every day, the users of TikTok, Zoom, Facebook, Instagram, LinkedIn, Netflix, pick your food delivery service. All of that data was created last year and had to be stored somewhere. So going forward, right now there are about 20 billion Internet of Things devices on the planet. So, almost 3 times the number of people on the planet. In the next 10 to 20 years, that's going to more than triple to over 60 billion connected devices, all creating data. Every time you do a barbell curl at the gym, your smartwatch is tracking that so that you can go in and show off at the bar, your gains, right? Mine is telling me I need to get up and put 250 steps in before the hour is done. All of that data that gets created every second, every minute has to be stored somewhere. So again, we can see that long-term runway of demand for data centers, and we can see the revenue growth. And so that's another area that we're interested in. And that in particular spans both real estate and infrastructure. So there are a number of areas where we see tremendous opportunities for growth going forward. But more importantly, we don't see any critical factors that would interrupt that growth. I'm sure that there was a guy who cornered the market on horse buggies and thought he had it made right up until they created the horseless carriage, right? And then all of a sudden his monopoly wasn't worth anything. So that's the important piece of it. Everyone can see those long-term trends. You really have to understand the risks that could undercut those long-term trends and structural drivers. So in these two cases, we just don't see it.
That's awesome.
Well, thank you, Dennis. Yeah, thank you so much for your time today. We love working with you. This was a great interview, so we really appreciate it. And yeah, have a great day.
Yeah, John, Evan, thank you very much for your support, the opportunity to compete for your business. We're looking forward to working with you guys closely going forward. And if there are any follow-ups, my team and I stand ready to help you guys out.
Awesome.
Stay
Thank you,
safe.
Dennis. Yeah, you too. Thank you very much.
Appreciate it.
Take care.
Cheers.